Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. I greatly appreciate it. This week up, we're going to take a look at American Express, the credit card company, in light of the new economic print, the new GDP number that was just printed, showing 2 quarters of real economic decline. That puts us into an official recession. That is the big word that's out there, and the market is absolutely hammered as a result. And when bad news is all around us, when everyone's saying the sky is falling, now is the time to start leading into the market. Certainly last year, around July time, this channel was indicating that the stock market was overloaded. I was starting to sell off and hold some cash. Now is the time to, very interesting, start picking out the pieces and start putting money to work. Let's take a look at Amex. You ready? Let's get to work. All right, now with all stocks, we're going to review 5 key factors that we use here at this channel to value stocks. Number 1, top line revenue growth. It's got to be growing. Number 2, EBITDA, enterprise level earnings needs to be growing. Number 3, we want strong free cash flow. Number 4 is low debt. And number 5 is a well-priced stock. We judge a well-priced stock at this channel by a conservative forecast, and that expected return beats the stock market. That's what we're looking for. So revenue for American Express, $32.8 billion in 2013. That has grown to most recent print $42 billion in the last fiscal year with really good stimulus spending. The current quarter in 2022 is very good, and Visa reported very strong numbers as well. So I'm encouraged to see this number continue to move forward. It could be that consumers are simply out of cash and they're turning to borrow because times are so difficult. Or it could be that things aren't as bad as they may appear, and at least with inflation, all goods that they're charging on the card is rising, and so Amex is going to be able to take another little clip on that dollar as costs of goods rise. EBITDA, $10.4 billion, kind of flat over that period of time, over the last years, and a solid spike here in 13. Very interesting, about 3% growth rate, 4% if I look back another year and kind of average it out. So it's growing in low single digits. I think that's something you could expect out going forward. Let's take a look at enterprise value. So the company does have debt on their books. Debt has actually declined over this period, which is nice to see as earnings have grown. Debt has come down, so we'd expect coverage ratios to increase. We like to see that, so $60 billion to $40 billion. They have excess cash in the books, about $20 billion of excess cash. So we're going to net these two to figure out how much total debt they have, like net debt. Market cap, $96 billion. This is average share price times average shares outstanding, or fully diluted shares outstanding. $96 billion to $124 billion over this roughly decade period of time. Now, if I add the debt plus the market cap, less the cash, I get enterprise value. And enterprise value is basically it's truly the value of the business. This is what you want to look at. If you look at the stock market, what they quote you is just this column, just the market cap. We want to include debt and cash to make sure we look at the entire enterprise, because we're measuring that against entire enterprise earnings. And what you're going to find is that the enterprise value has not grown over this last decade, yet earnings have, yet debt has come down. I like to see that. That's a good foundation for what we're looking for. Then what we're going to do is we're going to look at our debt ratios. Debt ratios have come from the highs of 4, right? That's above our 3 times debt to EBITDA ratio. That's come down most recently to 1.5 times. It's a nice conservative leveraged ratio for us. It's what we like. Enterprise value to EBITDA, that is right, our payback value ratio, or a relative value ratio, where I'm taking the enterprise value, the cost of everything, dividing it by its annual earnings to figure out how many years of earnings does this company need to generate to pay itself back. It's a way of looking at the time value of money in one number. And what you're going to see is it ranges from a high of, say, 16 times in the pandemic when earnings fell. So maybe a more normalized 13 times. A low of about 10 is probably the lowest. It's currently a little less than that. It's averaged 12, so we're looking for a range someplace in there. But I think that's pretty cheap for a business that is as high as it is. So that's enterprise value, that's revenue, EBITDA. Let's take a look at free cash flow and see what this business looks like. Okay, free cash flow, we're going to start obviously with the cash flow statement. My favorite statement, your favorite statement, the cash flow statement. CFO, cash flow from operations. That's the first third of the cash flow statement. It's usually a bold line. It says cash flow from operations. That's the number we're pulling. That's how much cash money, hard currency, the business generated lands in the bank account from operating their business. And it's different from EBITDA. It's different from net income because all of those P&L or income statement line items have non-cash charges in them. And what this is trying to do is just show you how much actual pure money did they generate each year. $8.5 billion, 11, 10. It will move around. All companies are going to fluctuate as you pay bills, the cadence of the timing. So it's going to move around. But in general, this cadence is moving up and to the right, which I like to see. It is moving. It's growing at 7% a year, which is a very nice, very healthy number. CAPEX is the money they put back in their infrastructure, back into the credit card infrastructure to continue to process more and more volume, to process different types of payments. This is how much they have to reinvest to keep that ball rolling. And that's growing in line with cash, maybe a little less. So they're slowly gaining a bit more cash every single year. Now the debt, as you can see, is mostly negative, meaning they've paid that down over time, which is what we saw in the balance sheet. Here from 60 billion to 49 billion, that point in time measure, right? The balance sheet is a point in time measure. A balance sheet is December 31st, March 31st, some date. Whereas cash flow and income statement, they're over time. It's this year's cash flow, this quarter's cash flow, or these 3 months of cash flow. So this cash flow is the monthly payments that they make down on the debt over time. It's the principal payment. It's not the total amount of debt they have. It's the principal payments. And as you can see, mostly negative. That's their buying down debt. Okay, great. Now, when I add these up, I get the free cash flow to the enterprise value. This is the total cash flow that's available to the equity owners, the stock owners that, like us, that are buying the stock. This is how much cash the business generates, and it's the basis for the value of the business of American Express. And that is growing at 5% annualized after paying down debt. And the interesting thing here that I like is now that the debt has been paid off, right? They don't need to pay the debt down anymore because the debt is 1.5 times earnings. There's no need to go down any lower than that. What does that mean? That means that instead of having to make a negative payment with this cash that they generate, it's going to flow right through to the equity holders. And now their debt annual debt is going to go much higher. So if I just zero these out for a little bit, average that down there, that's probably in the $10 billion a year basis. Divide by the shares outstanding, and I get a very healthy, that's probably $10 a share on average of free cash flow that this business generates, which is really, really nice. So just to finish the mock-up here, shares outstanding have continued to fall. They're taking that free cash flow and they're buying back shares. And what that means is it means that you as the equity owner have a business that is growing revenue, growing earnings, delevering, paying down debt, and buying back shares, which means your shares that you bought 10 years ago when there were 1 billion shares outstanding. Now, having not put anything else in the business, there's only 750 million shares outstanding. So your percent ownership of the business without having to put another dime into the business itself has grown by 25% over the last decade as they've gone from 1 billion shares to 759 million shares outstanding. So this is free cash flow per share. Here's the average share price and a yield. And it's interesting. Let's just take last couple years, get rid of the debt. The average yield here is almost double digit. That's a strong yield for a business, for a company that's been around for 100 years. So let's figure out how we can forecast this business. I'm going to show you a couple more tricks, things that I like to see to do with this kind of company, and let's move forward. All right, the next thing we want to check is the transaction volume. So American Express, much like Visa, MasterCard, PayPal, all these businesses, they take a small piece of the dollars washing through their credit card. You swipe your card, they charge the merchant a little fee, they charge you a little fee, and they just take a little small bit as all these billions or trillions of dollars are rolling through their system. So what we want to do is we want to take a look at how much volume is moving through their system, and is that volume growing? Because ultimately their earnings, the revenue and their earnings are based on the total amount of money moving through their system. So what I did here is I went back 20 years and just said, hey, look, what does revenue look like for 20 years? What does net income look like for 20 years? And most particularly, what does the gross volume of transactions look like for 20 years? And that covers some uptimes, some downtimes, just to get a feel for, if I bought it today and held it for a decade, what's the probability that the transaction volume continues to grow? And even though some years might be good years and bad years, as long as that transaction volume is continuing to grow, it gives them a good shot at being able to grow revenue. And what you're going to see, $300 billion, these are volumes are already in millions. So 300 million continues to grow from 2002 all the way. Here's the great financial crisis, a dip here. So there's a dip here, but then it jumps back after the great financial crisis and continues to go to $1 trillion in 2014, and it continues to grow all the way to present day, $1.8 trillion. So and you did see a small dip here again for the 2002 coronavirus dip. So it does fall in recessions. I think that's what the market is. The market is responding to. However, it seems to rebound. And I like that. So it gives you an opportunity to really step into the stock. This here is the net income divided by the volume. That's basically their profit margin. And what I did, because I need something else to do, I guess, and I graphed it just to show you guys graphically, because numbers are always hard to see. But you can see the blue bars are up and to the right and continuously growing. Their business, it looks like, has come down in margin a little bit into the financial crisis, probably deleveraging a little bit as that credit bubble just popped. Off to the side is their net income divided by the volume. So they're making about 0.5% on the total volume washing through their system, and they've been doing that for the last decade. It oscillates, obviously, but I think that gives me a decent level. How confident can you be? It's a guess, it's a forecast. But if the last 20 years this volume is going up here and they're averaging about 0.5%, that could be pretty good confidence that net income can continue to grow. So then the question is, what's the current stock price? And if that trend continued, how much could I make by holding the stock long term? All right, let's forecast. All right, so the forecast, we're going to pick up on EBITDA. And all I'm going to do is I'm going to take the EBITDA that they had last year, I'm going to grow it at 4%. Now, 4% is slightly higher than a 3%. I looked at it on a 10-year basis, and they grow at 4. If you go to a 9-year basis, which I showed you, it's 3. So all I'm trying to indicate is just a low single-digit long-term growth rate that they need to maintain. And this is obviously nominal dollars, so it includes inflation. So that makes it $13 billion of EBITDA and roughly 19, 20. I mean, this is all a guess, right? They call it forecasting because they don't want to say guessing, but realistically, it's just guessing. So I'm going to throw a dart way out into the future and say it's $19, $20 billion of EBITDA. 13 times multiple, because I do think the business is a little undervalued at 10. It deserves a little higher multiple. So I'm going to give it a 13 times. That's going to give me $250 million of enterprise value. I'm going to back off $30 billion of debt. I'm going to add to that $20 billion of cash, and I'm going to get a market cap that's roughly equal to enterprise value of $245 billion. I'm going to divide by the shares outstanding, 759 million current fully diluted shares today, and I'm going to get a stock price of $322.73. Out 10 years as a dart on the wall estimate. All right, let's check free cash flow. Now, free cash flow, remember, when I removed the debt payments that they've made, because they don't need to make those debt payments anymore. Their leverage ratio has come down. Now, all that cash can flow through. And when I flow it through, I'm getting $17.93 for next year, having grown it at 4%. I'm going to continue that growth rate. Same thing with EBITDA, because their CAPEX ratio isn't going to change. They're going to continue to pay taxes the way they do. So cash flow should mirror the growth rate of EBITDA. I get a 6% long-term yield. I get $422 out long-term decade from now. All right, let's go check out the current stock price and see how much money we can make by buying this stock. All right, here we are. So now we have two valuation methods, right? We did the free cash flow method where I took free cash flow and I stretched it out 10 years. I gave it a multiple. I get $425 long-term estimate. EBITDA market multiple, I get $322. I averaged those two for a $374 price target. Now, right now, if I look in the stock market, I could buy all the stock I want for $150 a share. It's pretty attractive. $150 a share, long-term target, it's almost twice that, plus I'm gonna get some cash flow. Now, what I said before is I said the current free cash flow is $17.90, I think, something like that. That's the number. Now, if I divide that by the price per share, if I divide that by the price per share, that's a 12% free cash flow yield. Now, you don't see very many stocks on this channel, even in the market, that is free cash flow yielding 12%, let alone a 150-year company like American Express. So I think that's a very interesting number and kind of a nice underpinning for risk-reward trade-off that we'll talk about in a second. But let's pop this sucker to an IRR and see what we get. Okay, here we are, IRR. I've got my cash flow here, which is not a dividend. It is your ownership percentage of the free cash flow that this business generates. And what do they do with that? Well, they could pay a dividend, which you will get some of it. They could buy back shares, which they have been in the past, which, by the way, is a tax-free way of growing your earnings. Don't forget that. And then last thing, they can make acquisitions. So if they want to buy other credit card brands or other payment processors, they can do that. Then I'm going to sell the stock at $374 out 10 years. When I put all that together, I'm at a 23% IRR, which is a very high number from this channel. We don't see that much. Certainly in the last year, we have not seen a lot of 20-plus IRR projections for companies that grow at low single digits annually. Let's put this into a matrix just so, it's YouTube, so you might look at this video 6 months from now, the stock has changed. Based on the numbers I gave you, long-term target, roughly $19 billion of EBITDA, throwing off free cash flow of $17 and growing a share. If the stock price moves up, I'm still a buyer. I still think it's very, very interesting. If the stock comes down because economic woes, blah, 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 we are here to take risks. Equity investors inherently will take risk, especially if you're a single stock buyer like myself. You are going to find yourself at times upside down on an investment. It's going to happen. If you think it's not, then don't buy the stock. But if this comes down, I would continue to lean in the stock. I think it's a very interesting investment. From a risk-return ratio, what are we talking about? We looked at, I showed you 20 years of transaction data that's moved up and to the right. We should look at 9 years of EBITDA EBITDA and revenue, which is growing at 4%, 3% annually. We've got free cash flow that's been growing at 7% a year, a 12% free cash flow yield. So I think there's a lot of favorability here in terms of a risk-reward basis, that if EBITDA grows more slowly, free cash flow grows more slowly, at least you're getting a strong free cash flow yield over time, and hopefully it pans out. You're not betting on a 20% growth rate like PayPal requires for its numbers to pan out. This is a much more interesting risk-reward trade-off. So I'm going to give it a good. I like the stock. I think the risk-reward trade-off is good, and I like how long it's been around in the industry. Let's recap the 5 key attributes for American Express. Number 1, top-line revenue growth. Yes, it's growing. Check the box. Number 2, EBITDA. Yeah, EBITDA is growing. Low single digits is growing. Number 3, strong free cash flow. Absolutely. Number 4, low debt. Yeah, it's less than 3 times. And number 5, is it well priced? Yes, I think it's well priced. Given the conservative forecast and the conservative market multiples, it still produces market-beating returns. We're estimating 20+% IRR over the decade. That's a strong return for relatively modest forecast and execution. So I think that, yes, checks the box. It definitely grows. Now, what I'm going to tell you is I teach a course on how to be a financial analyst, and I give you this Excel model. I walk you through 3 hours of content on how to value Apple is what I look at, and I show you how to find revenue, EBITDA, how to figure out what debt to include. It's not total liabilities. We are looking at long-term debt, short-term debt, leasehold improvements, capital leases. We figure out what the debt numbers. I show you how to calculate free cash flow, how to find the principal payments, how to calculate shares outstanding, if they split the stock, how to back that out. And then we build a forecast. Just like I did, I explain market multiples, yields, and we try to figure out how do you build a portfolio of 10 to 20 stocks that will set you up for your lifetime that you can walk away from and stop trading in the market. Buy a stock, own it for a decade, own it because you love the business. Much like I always thought Starbucks was a great company, and when I owned it, I would walk into Starbucks, I would pick up trash, and I would help clean up the restaurant. Because if you are an owner of the business, if you are a stock equity owner, it's your responsibility to help the business grow. Walk in there, clean things up with Amex. If you're buying it, I hope you use Amex credit cards. You should, as an equity owner. Anyways, that's a long tirade to say, check out my course, cashflowinvestingpro.com. It'll teach you how to be an analyst. It'll set you up for the rest of your life. It's a great course, a lot of great reviews. The other thing I will do is we have a club, a cash flow club. So the course you can do, and it teaches you how to run it. It requires you to obviously run the numbers yourself. If you want someone to run the numbers for you, I'm running the numbers on a whole host of stocks every month, printing one-pagers out. What is a cash flow one-pager? It's this. It is 10 years of financial information. It is a summary of the key attributes. It's a forecast. It's a write-up. It's everything you need to print out, keep off to the side, and when the market collapses like it is now, you start thumbing through all the one-pagers, you figure out which ones are the best, and you go out and go get them. Thank you very much. If you like the channel, if you like the style of what I'm doing, check the box for a subscribe. Share it on social media. I really appreciate the support. Up here is going to come a couple of videos of other stocks that I have reviewed that are the value-based style. Give it a view. Let me know what you think. Throw a comment down below. I really love to hear the comments and suggestions for other stocks. I'm going to go through a couple stocks here in the next couple months that I think are really interesting retail stocks. The market itself is down, and I think there's a really good opportunity for people to step in with cash and go buy things that are phenomenal for another decade. Remember, if you buy a stock and you hold it for the rest of your life and you gift it to your children, you pay zero capital gains tax. So this idea that you need to trade in and out, it just causes you to, even though you make money, you give 30% of that out to the federal government and you have to start with a lower dollar amount. But if you never sell, then that money continues to compound. And I think that's honestly the best way to go and build a wealth portfolio. You pick 20 stocks, you buy them, you hold them for 25 years. Yes, some of them will go to zero, but others will go to the moon in that time frame. And as a whole, as a portfolio, you'll be much better off owning a few stocks for a very, very long time than you will be trying to flip out and buy, flip in and out and buy the rager that everyone's talking about at the pub. So that's my take. This is Rational Investing. My name is Cameron Stewart. Thank you very much for watching American Express, the review, and we'll got another episode coming next week. Take care. Bye-bye.